Hi everyone, just waiting for people to join and we'll get going. Probably 1 minute past 11. Just wait a couple minutes. I'll share my screen while we're waiting. Morning, Henry.
Morning, Toby.
Let's just check we've got our screen share all set. As I said, we're just going to wait for everyone to join and probably get going at 1 minute past. People just joining now. We're just going to wait till 1 minute past before we get started. Okay, we're 1 minute past now, so hopefully we've got most people with us. I'm sure people will be joining in the next few minutes, but probably best to get started now. Welcome everyone to the webinar today on uncovering hidden wealth and winning clients in 2025. We start briefly with some introductions. I'm Toby, Senior Account Executive at Bowhurst. I spend most of my time talking to our advisory clients about how they can use data to win really high value long-term clients and take a smart approach to business development. Henry, I'll hand over to you to do a brief introduction as well.
Thanks, Toby. Yes, good morning, everyone. My name is Henry Whorwood. I run the research and consultancy team at Bowhurst. So my team handles everything that we do at Bowhurst that isn't our platform use cases. So we produce thought leadership reports for our clients, strategic papers, and a whole host of other sort of custom integrations and bespoke data sets and things like that.
Good stuff. And just to go through a quick agenda for today, Henry's going to start with a bit of a market update. We'll then move on to a few slides from me about winning clients in 2025. And then we'll move on to a Q&A at the end. So if there's any questions throughout, feel free to whack them in the chat and we'll come back to them at the end and see how many we can cover off. Henry, shall I start on your slides and I'll try and guess when to move on, but if not, do just say slide and I can go to the next one.
Thanks, Toby. Yeah, that works well for me. So yeah, thanks everyone for joining. Ahead of Toby giving you some insights into how you can use the platform, we thought it'd be helpful for us to give you some context and also tell you what our research is saying about the market anyway. So for when you end up reaching out to various entrepreneurs, founders, or investors, you can better understand the sort of context in which they're operating at the moment. Just to begin with, we've got some very headline statistics about where this sort of ecosystem of wealth generation amongst founders and entrepreneurs sits in the wider economy. So 5.5 million companies, active companies in the UK, all of which you can find on the Bowhurst platform. But within that, there's a very small subset that are this sort of innovation and growth economy. It's about 25,000 companies are getting innovation grants. This is since we started Bowhurst in 2011. About 31,000 have received investment, equity investment, and 37,000 also have one or more patents. So it's you're already digging in a very rarefied group. So better understanding them and approaching them sort of as effectively as possible is going to be key. The group that I'm going to focus on in these stats are the investee cohort. So there's about 31,000 of them. We've tracked them do almost 81,000 deals, almost 200 billion of investment, but the median deal size we've tracked so far is 273K. So not every founder makes it to their first round, and beyond the first round, not every founder makes it beyond to subsequent rounds. So understanding the sort of mechanisms by which wealth is being generated by these founders and these entrepreneurs is key. And so hopefully the stats that I'm about to talk you through on both the funding landscape and the exit landscape help give some context to that. So yeah, next slide. This is the overall picture, and it kind of sets the mood music for founders and entrepreneurs at the moment. Heading into the pandemic, things were moving up and to the right on a steady clip. Then they really leapt into another gear in 2021. And since then, things have been on a downward turn. The way to interpret this graph from a founder's perspective is quite important. Yes, there is a downturn. Yes, it is harder to raise than it's been previously. But in 2024, there was still just shy of 20 billion invested, over 5,000 deals. So there are a lot of investments and transactions still happening. It just is harder than it was during the pandemic. If we look at the quarterly picture, you see this shows you that there is a sort of greater degree of stability than that annual picture might have you believe. Yes, we're significantly down on the amounts, which are the bars there from the pandemic highs. But actually on a quarterly level, at least until halfway through last year, things were relatively stable. The real kicker has come much more recently. And Toby, if you click, it should give us another quarter. 2024 Q3 was bad. It was a bad quarter. And that has there are interesting reasons for that have implications for trying to find founders and thinking about their sort of wealth generation moments. It was largely caused by the budget, this dip, the sort of mooted and then enacted changes were, we've got a comment in the chat about someone not being able to see or hear anything. Is anyone else able to see or hear anything? If one person could indicate whether or not it's a universal problem, that would be helpful. Okay, great. Adebola, that might be on your end then. So good luck with that, and we will we will carry on, and we can catch up with you later. So yeah, so Q3 was bad, and it was driven by the budget. The Treasury and the Exchequer signaled that there were changes that were going to happen to CGT. They weren't as bad as they could have been in the end, but they did happen anyway. If you click again, Toby, we'll get a bit more, another quarter. We see a bit of recovery. Is that trajectory continuing? Toby, if you click again, we'll get yet another quarter. Sadly not. So it's not a sort of bounce back. Perhaps we are stabilizing at a new normal. And Toby, if you just one more click, that's obviously partial data for Q2. Based on where we are within the Q, I think it's reasonable that we'll probably be flat on Q1 to Q2. So there is a bit of a new normal we're entering into here. If we look at new ventures, which is basically the supply of investable opportunities, we're seeing a similar trend of steady growth into 2019. A bit of leveling off. Toby, if you click through. A bit of leveling off into 2020. Then we see a pandemic spike. And then from there, we see a pretty stark downwards trajectory. So in the previous chart, I would ascribe some of that to a budget impact, but this tells you that there's also something a bit more cyclical happening. The the whole sort of entrepreneurial market is stabilizing, and again is plateauing is more what I would say. These are the companies doing their first round, typically SEIS rounds. Come on to the next set of slides. The ones that are probably most important for the people who've joined us today. So this chart is showing the number of companies that had an exit in each quarter, number of equity-backed companies, so they've had some degree of angel or VC funding, and then have had an exit, basically where the early investors and the founders take something, usually quite a lot, off the table. The trajectory here is suddenly looking very positive. This is unfortunately a no, Toby, that's fine.
Good.
Keep showing that. So that is another budget effect in my interpretation. These are deals that people were trying to do ahead of the tax regime changing in April of this year. The changes to CGT were significant enough that for founders and early employees, the changes could mean as much as a difference of £90,000 in tax to each person disposing of shares. So it is reasonable that people thought it worth bringing deals forward. So we do see that. And then Toby, if you add an extra bit of data, we see that we're not at a new normal of record highs. We're at this sort of 100 level, and the data we have so far for Q2 suggests it will be around that level as well. So liquidity is an issue at the moment. It's affecting not just founders but also investors, kind of at all stages. There are on here. We're only showing majority acquisition exits, whether it's to a UK company or a foreign company. They're all included in these numbers. We haven't included IPOs here, just because then they're not very frequent. Some people do get exits and liquidities through it, but they're very, in an already rarefied group of transactions. They're the rarest bit. The most common route to exit for a UK entrepreneur is through a sale to another UK corporate. About 8 times out of 10, that's what it looks like. The other 2 times out of 10 are IPOs, sales to foreign buyers, or sales to private equity. So that's the main route. To try and give a bit of interpretation on this graph, will we see recovery from these sort of hundreds? The system is much bigger and needs more activity than this graph is currently showing. Unfortunately, that relies on basically UK corporates being confident. You do these kinds of deals when you are feeling bullish. And given everything that's happening with, for example, employers' national insurance, it's quite hard for those people to be feeling bullish at the moment. So I think, will we be stuck at around 100 transactions a quarter for a while? Well, it wouldn't surprise me if that's the case.
Thanks, Henry. To hopefully try and contextualize some of this, I guess, in terms of what it means for advisors, so wealth managers, private client lawyers, anyone wanting to work with high net worth individuals, essentially. The upshot kind of is more competition for a smaller pool of high net worth clients, or at least this kind of high net worth clients. And as hopefully Henry was kind of indicating too there, the markets are evolving fast. There's lots of changes in the dynamics of funding and M&A, but also the markets and subsects of companies that are actually getting investments. Obviously, lots of people riding the coattails of AI recently. And for advisors, this is all in a context of limited time actually to spend on business development often. So broadly speaking, the challenges are often you end up finding the same people. So people are looking at the same published liquidity events. This then means a large portion will already have an advisor, again, be it a private client advisor, be it a wealth manager, or alternative asset investments. And it's really hard to plan around your existing network. So a really good means of growing your client base is from who you know, word of mouth, but it's really hard to plan around this. And again, with the caveat of limited time each week, it's a tricky position to be in. So there's an argument to suggest then advisors need to be laser focused on these liquidity events. With fewer happening year on year, do you then just focus on those and chase them essentially? Know exactly who's exiting and attempt to connect with those founders and people making money from those exit events? Our view at Bowhurst is kind of yes and no. And to try and add some context to that, I'm going to start by talking about founders. And lots of this won't be news to the existing subscribers joining our call. But if we think firstly of a high growth entrepreneur, and the example I have here is the co-founders at Oxford Nanopore Technology. So this is a VC-backed company that spun out of Oxford in 2025 and went on to IPO in 2021 for 3.38 billion. And I happen to know that the founders of this business had a decent stake at this time, so obviously would make for a great client. However, it's kind of obvious if you manage to connect with them at this time, either via an intermediary or directly, they're going to probably turn you down saying, I already have an advisor in place. If we look at a different profile here, a more traditional business, we can look at Shortridge. So a family-owned business founded in 1845, acquired in 2024 for 24 million. Again, if you get in touch with this founder at this time or the people that benefited from the exit, they're going to be all set in terms of wealth management, private client law, whatever it might be. So there's obvious differences between these two businesses. I think one key thing these businesses have in common is there were opportunities between when they were founded to when they exited for advisors to connect with them and have built a relationship well before the exit actually happened. So our pitch at Bowhurst is shifting thinking away from exited founders to founders on track to exit. The question then arises, how do you find business owners on track to exit? And to talk through a few examples here, a great way of finding these is looking at previous funding rounds. So you can look at the frequency, value, and valuation of funding rounds to basically understand the growth trajectory of a business and their proximity to exit. So at Bowhurst, lots of our subscribers will look at businesses that have had VC or PE funding over 5 years ago. This means the investors are likely pushing for an exit and are incentivized to achieve that. And again, 70% of this funding never appears in the press. So the opportunity with Bowhurst specifically is getting there early with these individuals and having a really tailored messaging around business growth. Another thing we can be looking at is the profile of shareholders. So typically looking at those approaching retirement age, ones likely thinking about succession. And we can also layer in ones with age diversity on the board. This then meets a profile of a business that's more likely family owned and more likely thinking about an MBO, MBI. And there's a massive opportunity here. There's over 90,000 people in the UK, age 60 plus, that have a board position at a company with over 1 mil cash in the bank. So the potential to exit for a decent fee and probably thinking about their succession planning. Now, where you draw the line as to where you want to build a relationship is sort of up to you. But again, the opportunity is getting there early, finding soon to be high net worth individuals that others are missing, and really tailoring your messaging based on what you know is on their mind. Another really interesting data point to look at is historic MBO, MBI activity. So a company that's been bought in or bought out by the leadership team. These businesses likely have an evolving exit strategy and themselves will look to exit in 5 to 10 years after the MBO. You can sort of double down on this here and actually also look at financial or other growth metrics since the MBO. Means they're likely realizing their exit strategy and approaching that exit horizon. In the UK, there's over 1,000 companies that underwent an MBO, MBI 5 to 10 years ago that are also showing significant signs of growth. Again, a really good tailored strategy here can be built around this. You know where they're at in their thinking and you can, again, connect early. There's loads of other pre-transactional exit signals to be looking at, and some key ones that we recommend at Bowhurst are C-suite appointments. A company will often hire a CFO before going on to an exit. Accelerator attendance, so there's actually key programs designed to help companies get exit ready. Exponential growth in headcount or revenue, again, positioning the business that now is a good time to exit. There's also some things on the balance sheet. A significant one is actually reporting full financials before reaching the 10 mil turnover threshold. There's no reason to do this apart from to demonstrate to investors and acquirers what's going on financially. And then finally, changes to the board. A general hiring of a non-exec or exec director is one thing, but actually looking for key people that have experience at previously exited businesses. When they join a new board, you can be pretty sure that that's why they've come on board as well. So that's one side of things, connecting with founders on track to exit and building a strategy around that so you have a relationship when the exit event happens. Another thing to be looking at is not just the founders, but also the shareholders and directors, potentially some people around the business ecosystem making money that are less targeted in this space. So we can kind of think of this as silent wealth. And the two profiles I'm going to focus on today are angel investors and directors taking out significant emoluments from profitable companies each year. If we look firstly at angel investors then, there's nearly 23,000 people in the UK with over £1 million equity investment in private companies. And this estimated paper wealth is taken from the pre and post money valuation data we have. And significantly here, there's just over 11,000 here that are actually non-founders. So these are people with significant investable wealth. If you think, roughly 10% max of people's investable wealth is in things like private companies, they're going to have large amounts of liquidity. And this is unlikely to be listed on LinkedIn. Most founders or investors rather won't list their investments and are very unlikely to list the amount they're investing. So a pool of individuals here that aren't really being targeted by people that don't have access to this kind of data. On the director side of things, if we pick out a specific pool here, there's just over 7,000 companies that are paying over £1 million in annual director emoluments. And last year, these group of companies paid 54 billion to a set of 35,000 directors. Now you can do the maths dividing one by the other. This will obviously be loaded and weighted to certain individuals. But the point here is there's another massive pool of individuals here that are making lots of money around companies that aren't being targeted in the same volume as the founders themselves. Again, I'm sure lots of you will have clients who meet this criteria of a director with money being taken from one business, lots of businesses. They're really hard to find. They don't all go to the same place, and they don't list this again on profiles like LinkedIn. So there's a really good opportunity here. The next question that will often arise when I talk to someone about data and using this data is, we're not in sales. How do we leverage this? I don't have time to be trawling through data. And they're all perfectly valid initial assumptions to make. I do see myself as a salesperson, so to maybe push back on some of this, the pitch that we suggest with Bowhurst and using the platform is the smart business development. So if we take some specific profiles here, firstly, a young advisor at a wealth management business looking to grow their network, who's obviously focused on the business development. What we might suggest here is actually building an ideal client profile. So maybe they go for fintech founders, and then picking a point at which they want to start connecting with them. So maybe it's the first small angel investment. They send some LinkedIn connections. We'll then set up some weekly alerts so they can monitor these founders as they grow. There's then a narrowing funnel of which ones are moving towards liquidity events. And that's when you can look to build a relationship, start inviting them to events, sending over some thought leadership. And 5 to 10 years time, the colleagues of this young advisor are going to be looking around. How do you know so many business owners that are exiting? How have you landed these big clients? Really, the answer was some pretty well-directed LinkedIn connections a few years back. If we look maybe here at a different profile, a private client lawyer looking to work with more high net worth individuals, but not sure where to start. There's a really interesting thing they can do actually by just using the platform. Directors and angel investors already connected to clients that they're working with, and just seeing who are the high net worths I can already leverage an introduction to. That's before even going out to the market as well. With a newly promoted director in either a law firm or a advisory wealth management space, looking to win some big clients, what they can do is start uploading lists of people they've met, people they know, and get weekly alerts on these new connections that are emerging. So we're tracking directorship, shareholdings, key positions, and they can just get a stream of, okay, someone you previously met looks like they're moving towards liquidity. Someone you already have as a client is actually joined the board of someone else, and there's loads of people you can work there. And we can enable this warm network-based approach that doesn't require mass cold outreach. And links nicely onto the final one here, which is a senior advisor who hates the idea of any cold outreach, will only work off intermediaries and introductions. Now, probably not time today because we want to move to a Q&A to go into the detail of this. Essentially, we can help them find the best intermediaries that gives them greatest access to the target market they want to work with, and also track them and leverage them to see who they can actually get introductions to. This is looking at direct shareholdings, auditors, who people bank with via charges and mortgages, loads of other things here. Hopefully that all makes sense. It's a very brief introduction to some of the ways we can help that will be familiar to some people we have on call today. We'd like to open up to a bit of a Q&A. Probably don't have time for loads of questions. I may have waffled on slightly. But yeah, we'd like to open up to the floor to any questions we have.
Well, Toby, we've got one that I can take that came in the chat from Mark about Pisces, just quickly. Which for anyone who doesn't know is the platform being developed by the London Stock Exchange to provide more secondary liquidity to business owners and founders. What I'm hearing on the ground is that there's a very interesting group of companies being prepared for that market. Some that are maybe a bit unexpected that they would be interested in providing or creating that secondary opportunity for investors. Matching the investors is proving harder. It was always going to be the harder part of the equation. So I think that's the bit that there's a question mark of getting that right. Hopefully it goes without saying that as soon as those companies are starting to use that mechanism for secondary liquidity, you will also be able to see that on Bowhurst and track the activity of Pisces and the companies there as well.
We've got another question here about how you use Bowhurst to spot warm introductions. Essentially, there are a number of ways that I kind of touched on there. It's about uploading a short list of people you're already connected to. And then we can use that to see where you have warm introductions via mutual board positions, shareholdings and cap tables, and key positions. So the output is kind of a bit like a LinkedIn, but it's a very different model. It's not, you've got thousands of connections. Here's who you can leverage an introduction to. It's more, here's 30 people that have introduced people to you in the past. Let's really double down to see where they're connected to other businesses and other high net worth individuals. There's then a whole other network of intermediaries around auditors, banks, potentially even VCs, accelerators. So yeah, it's about spotting the introductions you already have to better leverage your intermediaries as they currently stand, but then also finding new ones. If you've got an intermediary business development strategy, who are the 5 people and 3 organizations that mean you can actually access the most high net worth individuals per hour spent, I guess. I think another thing, unless you have other questions to touch on in terms of secondaries that Henry mentioned there, I think all the more reason to be connecting with founders on this trajectory if they're finding other ways to realize liquidity. The kind of pitch we have with Bowhurst isn't just find people that will someday be a good client. It's about finding people that right now are a good client, but they have even more likelihood of becoming, ultra high net worth or realizing massive liquidity. And the secondary market provides a good means for them to be realizing capital en route to exit as well. In terms of deciding an ideal client profile, again, lots of different ways to do it. What we actually recommend is starting with your existing client base, looking at who do you have there already that represents a client that you're best placed to serve, but also, to put it crudely, one that generates you the most fees, and then looking out to the market and replicating that. Let's find another 50 people that match the criteria of your best current client. And alongside this, it's kind of just testing different profiles that align with like interests or experience. And again, to use the classic example of fintech, if you've worked with quite a few fintech founders, you're probably good at having conversations with them. So it's like not just leveraging what's good for the business, but also leveraging your experience as it stands as well. I think that's probably all questions for now. So you can probably give people two minutes of their time back, unless there's anything else from you, Henry.
No, nothing more from me. Thanks everyone for joining.
Great stuff. Yeah, thanks for joining everyone. Picture of me here that you can look at for a few minutes. And if there's any interest in terms of exploring the platform, feel free to drop me an email or give me a call. And yeah, feel free to reach out to Henry on the report side of things. And yeah, thank you all for joining.